Hello and welcome back to another week of your Mortgage Market Movers Weekly, where we are detailing everything that's going on in the macroeconomy to help you make better home buying decisions. This week's 30-year fix is sitting at a 6.3, which is up just a hair from last week's 6.26. In the economic calendar this week, we are looking at crucial job data that is going to inform us whether or not the Fed is likely to give another rate cut at their next meeting. However, we may or may not get that information. Depends on the government shutdown. So we are going to take a look at the charts and see what's going on. The charts. So the intro video discussed a potential government shutdown, which did end up happening. And it looks like the markets are largely unaffected. So we can see this red bar right here is the U.S. 10-year for Wednesday, October the 1st, which would be the day of the shutdown. Looks like the U.S. 10-year is coming down, which means people are buying into the bond market. People aren't particularly concerned, it seems, about the government shutdown, at least not in the bond or equities markets. So the 10-year hit these lows around mid-September, came back up a little bit, and it looks like today we've had a good little drop in the rates. So hopefully these keep coming down. It's probably going to be pretty tough to get past this, like we'll call it like 4.25, 4.025. It's probably going to be a bit tough to get down below that. As we kind of see, there's this like little bit of a floor right here. So really what it's going to take is the bond market rallying again. And the thing about the interest rate cut with the Feds is that it was largely priced in, and what that means is the market was already expecting it. Because the market was already expecting it, it's not as if the market's, people weren't surprised. It's not like people were surprised that the Fed decided to cut rates. So there's no reason to keep buying. The investors who were buying bonds bought prior to the event because the likelihood was like a 97% chance of them cutting rates. So that's why there's a little bit of alleviation afterwards, a little bit of a sell-off of the bonds. So mortgage rates came up just a hair, and now they're probably going to settle somewhere around here. They might come a little bit lower. We'll take a look in a little bit, but I want to say that there are 1 to 2 more rate cuts priced in at this point. So we will have to see what happens with the data. The interesting thing with this government shutdown, though, is we will not be able to see the Friday data come out, which is important labor data. So I think that actually pushed the odds even higher for a rate cut, surprisingly. So, or I guess maybe not surprisingly. If we don't have that data, they can't use it to inform them of their decision. So let's see. So Monday we had pending home sales, and home sales are up. So that's good. Month over month, up 4%. Forecasted to be a 0.2. So pretty solid beat, up a good bit. Let's see. We had job openings, and this came in higher than expected. So there were more jobs available. And the market... So because that's a good thing, and because if the labor market is strong or gets stronger, then the Fed will have less reason to cut rates. Right now they have a dual mandate to make sure that the labor market doesn't deteriorate, nor does inflation get too high. So for a little bit, the labor data was looking pretty rough. And this led to the Fed's decision to have a rate cut. If the labor situation turns around and we see stronger labor data, then there, like I said, won't be as much of a reason to cut rates. So it's pretty, balancing that, the labor data and the market as a whole is kind of a finicky thing, right? We don't want inflation to go crazy high, and as we've seen with PPI and CPI, inflation has ticked up. But we also don't want the labor market to deteriorate, right? We don't want any kind of bad long-term economics, right? So the Fed is definitely in a precarious position right now trying to balance those. We had, let's see, I don't know why this isn't here. Let me refresh this page. Okay, there you go. So the ADP non-farm employment change. So there was a decrease in 32,000 employed people, excluding farming and industry and the government during the previous month. So that is pretty rough labor data right there. Let me see. The manufacturing prices is, let's see, this is like a purchasing managers index. It's a survey. It looks like manufacturing prices are elevated. Anything above a 50 is an elevation. Below 50 is a contraction. However, they're not as elevated as things were appearing to be or forecasted to be. Manufacturing, however, let's see. I mean, essentially just the forecast, but it was better than previous. However, still a contraction in manufacturing. So manufacturing is not doing too hot, at least the previous month. And like I said, so I think that we get, okay, I see it's tentative now. So depending on when the government opens back up, the likelihood of them reopening the government, by end of day today or by tomorrow morning, Thursday morning, pretty low in my estimations. Anything can happen in the market. So it looks like we probably won't be getting unemployment claims, nor will we be getting all of the labor data down here on Friday. Like I said, I believe it was actually good for the probabilities, though. Let's look at the Fed Watch tool. Yeah, it's a 99% probability now of a rate cut at the end of October. So, I mean, the market is just assuming that this will virtually definitively happen at the end of October. And then we have one more. So that'll be our third rate cut of the year. And this is 86.9% odds in December. So the market's expecting it right now. It's more than likely going to happen. Could mortgage rates come down still? I think that they can come down a lot, but I don't think that we're going to get anything crazy. I think that people are maybe hoping for, we see people, right? And maybe it's a good time for them to refinance. They could save, $400 to sometimes like $1,000. And they say, well, I'm going to wait for the rates to come down. And probably not the best move. Like I said, the market's already anticipating that this is going to happen. So I personally don't think there's going to be any like dramatic mortgage interest rate cuts after the Fed. Maybe leading up. Sometimes it's a buy the rumor, sell the news kind of deal. So maybe that could happen, but I would not cross my fingers. But by the time we get to mid-2026, it looks like we'll have 1, 2, 3, 4 rate cuts. So we will see. We will see. A lot can happen between now and then. Okay. Like I said, the 30-year fix is sitting at 6.3, up about what is that? Like 4 basis points from last week's 6.26. And that's about all I have for you. So if anyone has any questions, reach out to us at www.mortgagesbylinda.com or contact us at 877-TEAM-MBL. Have a great week. Bye.